In November 2022, FTX held a $32 billion valuation. Within 10 days, it held nothing. That collapse was not an anomaly. It was the latest in a pattern spanning dot-com retailers, hedge funds, pharmaceutical roll-ups, and blank check companies. We ranked 10 investments that destroyed the most capital while carrying full institutional endorsement. The countdown starts at number 10. It is a company that lost money on every order it shipped. In the 10th place, Pets.com stands as the textbook case of unit economics' overwhelming narrative hype. The company went public on February 11, 2000 at $11 per share. Amazon's stake diluted to just over 30%, and major analysts issued buy ratings that pushed the stock up 15% on its first day. But the business model was fatally flawed. In the fourth quarter of 1999, Pets.com reported a negative gross margin of $6.4 million and a net loss of $42.4 million on $5.2 million of revenue. Every order shipped at a loss, with shipping and fulfillment costs exceeding the sale price. In just 268 days as a public company, nearly $300 million of capital was destroyed. By November 9, 2000, the company liquidated at 19 cents per share. Jeff Bezos publicly defended the investment, but the numbers had always told a different story. Number 9. Long-term capital management operated with leverage of approximately 25-to-1 against its equity base. The fund was managed by John Meriwether, with Nobel laureates Myron Scholes and Robert Merton designing the quantitative models that guided its trades. In September 1998, the Russian government defaulted on its sovereign bonds, triggering a breakdown in the correlations that LTCM relied upon. The firm held $125 billion in notional exposure, supported by just $4.7 billion of equity. Losses reached $4.6 billion in a matter of weeks. To prevent systemic contagion, the Federal Reserve organized a private bailout of $3.6 billion, orchestrated by a consortium of major Wall Street banks. LTCM's collapse demonstrated how even the most sophisticated risk models can fail catastrophically when market assumptions break down under stress. Number 8. Nortel Networks built its growth on vendor financing arrangements that allowed the company to book equipment sales as immediate revenue while extending credit to customers. This accounting loop inflated reported earnings and masked underlying cash flow weakness. Between 2003 and 2005, Nortel issued 3 separate earnings restatements, each correcting prior period revenue and exposing the fragility of its balance sheet. The resulting loss of investor confidence erased approximately $250 billion of market capitalization from its peak in early 2000. In 2008, former Chief Executive Frank Dunn faced criminal fraud charges tied to the manipulation of financial results. By 2011, Nortel's remaining patent portfolio sold for $4.5 billion in bankruptcy proceedings, a fraction of its former value. The Nortel episode illustrates how revenue recognition choices and off-balance sheet financing can manufacture apparent profitability, drawing in institutional investors while concealing mounting risk. Number 7. Valeant Pharmaceuticals built its business on the rapid acquisition of drug portfolios and immediate price escalations. After purchasing Isuprel, Valeant raised its price by 525%. Nitropress saw a 212% increase. These hikes were justified internally as value-based, but the real engine was a specialty pharmacy network anchored by Philidor Rx services. Philidor operated as a related party, yet Valeant did not disclose this relationship in its public filings until late 2015. This arrangement let Valeant book revenue at the point of sale, inflating reported growth and bypassing traditional price controls. At its peak in August 2015, Valeant's market value reached $129 billion. By the end of 2016, that figure had fallen by $90 billion. Pershing Square, led by Bill Ackman, lost $4 billion on its position. In 2018, Valeant rebranded as Bausch Health, seeking distance from the scandal. Number 6. WeWork's rise and collapse exposed a credibility gap at the heart of private market valuations. In January 2019, SoftBank's Vision Fund valued the company at $47 billion, despite financial statements that revealed a net loss of $1.6 billion on just $1.8 billion of revenue. The August 2019 S-1 filing introduced the term Community-Adjusted EBITDA, a non-GAAP metric that excluded basic operating expenses and attempted to recast mounting losses as a sign of future potential. As the IPO roadshow began, mainstream analysts and business media still described WeWork as a disruptive technology company rather than a real estate sublessor with negative cash flow. By September 30th, 2019, the IPO was withdrawn after investor scrutiny of governance, related party transactions, and the lack of a clear path to profitability. SoftBank stepped in with a rescue package that dropped the company's valuation to approximately $8 billion, resulting in a $14 billion write-down. In November 2023, WeWork filed for bankruptcy, marking the end of a cycle in which narrative valuation repeatedly overruled basic cash burn realities. Number 5, Theranos raised $945 million from private investors, including Rupert Murdoch, the Walton family, and Larry Ellison. The company's board featured statesmen and generals, Henry Kissinger, George Shultz, and James Mattis, but it lacked medical or scientific expertise. Despite claims that its blood testing technology could run hundreds of diagnostic tests from a single drop of blood, Theranos never produced credible validation data. For years, high-profile investors and media outlets repeated the company's narrative, while regulatory filings and investigative reporting by John Carreyrou revealed that the core technology did not work. In January 2022, Elizabeth Holmes was convicted on 4 counts of fraud and conspiracy. She was sentenced to 11 years and 3 months in federal prison. Theranos stands as a case where prestige and narrative overrode basic due diligence, obscuring the absence of scientific proof until criminal charges made the losses undeniable. Number 4, Archegos Capital Management used total return swaps to build concentrated positions exceeding $100 billion in notional exposure. The firm, led by Bill Huang, operated as a private family office, sidestepping public disclosure requirements. By relying on synthetic derivatives, Archegos masked the scale of its bets from both the market and its own counterparties. On March 25, 2021, margin calls from Credit Suisse, Nomura, and Morgan Stanley triggered a forced unwind. Credit Suisse reported a $5.5 billion loss, Nomura a $2.9 billion loss, and Morgan Stanley $911 million. The combined market impact erased $36 billion of equity value in days. The episode exposed how opaque leverage, hidden through swap agreements, can propagate losses across the global banking system before risk controls even register the danger. Coming to the top 3, Ark Innovation ETF reached $28 billion in assets under management at its February 2021 peak. The fund concentrated its exposure in high-growth technology names like Teladoc, Roku, Zoom, and Coinbase. As market sentiment turned, these top holdings collapsed. Teladoc lost 92% of its value, Roku 89%, Zoom 88%, and Coinbase 86% from their respective highs. Retail inflows surged during the fund's ascent, amplifying losses when momentum reversed. By the end of 2022, assets under management had fallen below $6 billion. Morningstar's 2023 study estimated that Ark Innovation ETF destroyed over $14.3 billion in shareholder value, a figure driven not by insolvency, but by the scale and crowding of thematic bets. The fund's decline revealed how visible concentration risk and narrative-driven positioning can inflict market-wide losses, even in the absence of hidden leverage or accounting fraud. Number 2, the 2021 SPAC Cohort marked the largest wave of special-purpose acquisition companies ever recorded. In that single year, 613 SPACs raised $162 billion, with institutional sponsors and major banks underwriting the boom. Each SPAC merged with a private target, bringing it public at a reference price of $10 per share. Yet, the structure embedded sponsor warrants and earnouts that diluted ordinary shareholders after closing. By the end of 2023, the median post-merger price had collapsed to just $2. High-profile failures such as Lordstown Motors, Lucid, Virgin Galactic, and BuzzFeed illustrated the pattern. Initial optimism, followed by rapid value evaporation once financials became public. In response, the Securities and Exchange Commission issued new guidance in 2022, requiring clearer disclosure of dilution and conflicts of interest. SPAC's issuance volume fell by 95%, and aggregate shareholder losses reached an estimated $200 billion. The cycle exposed how misaligned incentives and structural dilution can destroy capital on a scale rivaled only by outright fraud. And finally, in first place, FTX and Alameda Research represent the most complete collapse of investor trust and capital in the modern era. At its peak in January 2022, FTX was valued at $32 billion, with a roster of backers that included Sequoia Capital, BlackRock, Tiger Global, Temasek, and the Ontario Teachers Pension Plan. The platform's public image rested on claims of secure custody and robust risk controls, but a single line of custom code, the so-called allow negative exception, granted Alameda Research the ability to bypass automated liquidation protocols. This code exception enabled the commingling of customer deposits and proprietary trading, creating an $8 billion shortfall that remained undisclosed until the liquidity crisis of November 2022. On November 11th, FTX filed for Chapter 11 bankruptcy, instantly erasing the $32 billion valuation and rendering all equity worthless. Sequoia Capital alone wrote down $214 million to zero. The bankruptcy examiner's report, along with filings from the Department of Justice and the Securities and Exchange Commission, documented the deliberate breach of custody and internal controls. In November 2023, Sam Bankman-Fried was convicted of fraud and sentenced to 25 years in federal prison. The FTX case stands as definitive proof that institutional endorsement and analyst optimism cannot substitute for forensic scrutiny of code, governance, and cash flows. The numbers had always told a different story. Across all 10 cases, one pattern persists. Capital destruction on this scale always followed visible, quantifiable signals, including leverage ratios, related party structures, unit economics, or distorted incentives. Institutional endorsement repeatedly obscured these facts. The real risk today is not ignorance, but the decision to ignore what the numbers already prove.